China's COVID crunch. As the virus sweeps through the world's second biggest economy, a growing number of countries impose travel restrictions. Global markets are on course for their worst year since the 2008 financial crisis. So what's in store for the new year? Hello and welcome to World Business Report. I'm Jonathan Josephs. Thanks for joining us wherever in the world you are. As coronavirus continues to sweep across China, a growing number of countries are imposing new travel restrictions on the world's second biggest economy. Spain has followed Italy to become the second European country to do so. India, Japan and the United States are also imposing new rules. Chinese state media has dismissed the restrictions as unfounded and discriminatory. Either way, they're bad news for the aviation industry, which was hoping that 2023 would be the year it returned to profit after losing nearly $200 billion because of the pandemic. It could also have wider consequences for the global economy. Well, I've been speaking to the aviation consultant John Strickland and asked him for an overview of the restrictions and their impact.
Well, Vita, coming in quite quickly. We're hearing almost every few hours of a new restriction in place. As you said, a number of other Asian countries have introduced restrictions on arrivals. The USA, Italy, and now Spain in Europe are talking about doing so. We should put this in context of the fact that on the one hand, pre-pandemic China travel outbound, the Chinese public traveling worldwide was the biggest market in the world in terms of the scope of travel and the value to airlines and indeed to tourism. Of course, it's been a level of zero activity because of the COVID restrictions, and we're not now talking about a sudden return. We're talking about a handful of flights at this stage, but websites that look at passenger booking patterns are already seeing a surge of interest. So governments are naturally concerned, given that we don't have great transparency on what is actually happening with COVID infection rates and numbers and indeed variants in China, that we have to be ready to handle this impact of growing travel quickly and effectively.
You talk of growing government concerns, and I just wonder, after a year where the aviation industry kind of thought it was putting this whole episode behind it in many ways, how ready is the industry to be on the front line again, really, in terms of enforcing these restrictions and making sure that they work?
I think the challenge is a very real one. The biggest difficulty we saw throughout COVID was the massive inconsistency of governments around the world. Every government was doing its own thing. We're seeing elements of that already here, where Italy's talking about swabbing arriving passengers. Others, such as the US, are demanding a negative COVID test before travel. The biggest challenge for an airline, or indeed the industry as a whole, is to have consistency around the world, because it's impossible to communicate with customers and staff if there are differences in every country. We now have much more technology. The industry body IATA, for example, worked on apps, and there are several available now which provide information. We do need to see the lessons learned from the wider COVID pandemic of the last 2 years, where we apply a consistent approach. And it is worrying that European countries are taking an individual approach right now, because that's going to cause challenges if we get into a bit of a panic spiral of activity by governments that are not able to be handled by the airlines.
John, just very briefly, in about 15 seconds, can you just tell us how much of an impact will this have on profitability for the airline industry, given it's lost $200 billion already because of the pandemic?
We can't say precisely. The positive would be if the Chinese market opens up and we can manage whatever the state of the pandemic is there. There'll be a big positive impact for those airlines who operate to and from Asia and to China in particular. It would be a real positive recovery to match what we've seen, for example, in Europe and the US over the last year, where traffic has come back strongly. So we have to look at it in that positive way, but it has to be managed carefully so we don't over panic and have this challenge in implementing checks.
Well, that was the aviation consultant John Strickland. Now, it's the last day of trading for global stock markets this year, and it's not been a good one for them. Amid the broader economic downturn, the MSCI Global Index, which is one of the key barometers for tracking how global markets are doing, is set for a 20% drop this year amid the war in Ukraine and the impact that's had on inflation. Now, let's have a look at how financial markets are doing in today's trading. As you can see here, FTSE 100 in London, that's actually closed early because of the New Year holiday. For the year overall, it's down about 0.7%, which makes it one of the better performing stock indices in the world. Whereas in Germany, you can see the DAX there and also in France, the CAC are both down. But in Germany, it's a 13% fall for the year, and in France, about a 10% fall. And it's not been much better in Asia, where although there was a little bit of positive news in the latest trading session, Japan was down 11% for the year and Hong Kong about 15%. So not a pretty picture. And we can look at the state of things in the United States with our North America business correspondent, Samira Hussein, who joins us for one last time in 2022. Samira, what's the picture in the US? Why is it looking so bad?
Well, I think pretty much stocks this year are really happy to say goodbye to 2022 because, as you rightly pointed out, JJ, it was the worst year for stocks since 2008. And remember, in 2008, we were contending with the global financial crisis. The reason why it was so bad were for some of the reasons that you outlined. Of course, there is the war in Ukraine, the impact that's having on energy prices, inflation, but also if you look at tech stocks have just been obliterated this year. Think about some of the biggest names. Meta, for example, has dropped by more than 60% this year. Tesla has also dropped by more than 60% this year. Even Amazon, which sometimes can look like a company that can never go down, has dropped by more than 50%. A lot of tech companies are hunkering down, preparing themselves for a possible recession in 2023. So whether or not it's going to be a better year for 2023 for tech stocks, I think there's quite a lot of people that are debating whether there's going to be some kind of rebound or we're going to continue to see them slipping.
And one reason the stock markets have suffered so much is because interest rates have been going up, and that's meant better returns for investors there. What's the expectations for 2023? Are we likely to see more increases in interest rates from the Federal Reserve, the central bank there? And what impact might that have on the US economy?
Well, I think it's pretty certain that we're going to still see some more interest rate rises. I think the question is really how big those raises are going to be. Remember, in 2022, we saw that the Federal Reserve raised interest rates by 0.75%. 4 times. And that's, something that we'd never really seen before. Whether those big jumps are going to continue, I think will really depend on a lot of economic data that comes out next year. We've already seen 2 consecutive reports that shows that it's possible that inflation is in fact receding. We're also seeing some evidence of some softening within the labor market. That's probably going to be good news when it comes to not raising interest rates too much.
So plenty to keep our eyes on next year. Samira, for the last time this year, thank you very much for joining us from New York. Now, let's look at some other business stories this hour. The Chinese authorities have given 2 companies permission to test fully driverless cars in Beijing. They are the tech giant Baidu and a startup called Pony.ai, which has backing from the world's biggest car maker, Toyota. Each company will test 10 vehicles on a technology park in the Chinese capital. Driverless vehicles is an area of increasing competition amongst car makers around the world, but their development has been slowed down by growing safety regulations in many countries. Russia's President Vladimir Putin has said that his country has become one of China's biggest fossil fuel suppliers. In a video call with President Xi, Mr. Putin said as well as being China's biggest oil supplier, it's now its number 2 supplier of pipeline gas and number 4 for liquefied natural gas. Russia has been looking for alternative options for its exports because Europe has moved away from them as a result of the war in Ukraine. The Japanese arm of the failed cryptocurrency exchange FTX says it plans to return customer assets from February. Meanwhile, the authorities in the Bahamas, from where founder Sam Bankman-Fried was running the company, say they are holding around $3.5 trillion of assets from the collapsed firm that they intend to return to customers and creditors. The platform filed for bankruptcy in November, leaving many customers wondering if they will ever see their money again. Well, that's all we've got time for on World Business Report this year. Do join us again next year for plenty more on the global economy. In the meantime, there's lots more on the website at bbc.com/business. Bye for now.